Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about all things financial literacy. And today we're going to be talking about FICO scores, the different FICO models, and then breaking down each of the scoring models. Now, I've had a lot of questions about FICO scores, exactly what makes them up, the components of each score, and exactly which score each lender pulls from. And the thing about that is every lender will pull from a different scoring model, but the one that's used primarily will be your FICO score. So we're going to go over all the different ones that there are, the ones that you should look out for when you're applying for particular items such as credit cards, mortgages, or auto loans, and really how you can strengthen that score overall to get more approvals. Now, if you have no idea what FICO is or FICO scores or what's the difference between a FICO score and a credit score, then this is the perfect video for you. So without further ado, let's get right into the video. Now, the first thing I want to talk about is the company FICO. We have talked about them before, and I have another video that goes over all the details of that. I also have a video that goes over the difference of a score you see on Credit Karma, a Vantage score, and then a FICO score. But FICO, to do a brief overview, is the most widely used credit score that's available. More lenders use FICO than any other scoring model. That's the reason why we focus on this one primarily. So the credit score is created by Fair Isaac Corporation. 90% of lenders will be using this score to help them make billions of credit related decisions every single year. FICO scores are calculated based on information in a consumer's credit report maintained by the credit bureaus. So the credit bureaus are not the ones who actually add all of the different components to make up your score. They're just the ones that will add the information, and based on the information they add or take away, will adjust that score. This is the formula, the model that actually makes up your score. Whatever they add or take away can then make that score go up or down. Just depends on what's on the report. Experian, Equifax, and TransUnion all use these scores. And by comparing this information to the patterns in hundreds and thousands of past credit reports, FICO scores estimate your level of future credit risk, or how likely you are to repay on a loan, and if you're going to pay that loan back on time. I've said it before, I'll say it again. All a credit report is basically your report card. It's your report card, your adult report card for how well you pay back. That's it. It's how well you are willing to give money back once it's borrowed. That is it. That's the reason why you don't get a credit score if you don't take on debt. You only can get a credit score if you have some debt to pay back, which is why it's important for you to participate in paying off debt. If you have no accounts, you basically would have no score, right? How can we have a score with nothing to base a score off of? So you definitely need to make sure that you have positive accounts. And if you only have negative, then of course the score can only be negative. Now, to break down exactly what a FICO score is a 3-digit number based on the information in your credit report. Like I was saying before, whatever is on your report will then adjust this 3-digit number. It just depends on what you have. If it's positive or it's what's feeding this to give you a higher score, then you'll get it. If it's not, it'll be lower. That's the reason why we want to understand exactly what this is, how this is made up, and exactly how we can manipulate it. That's the purpose of knowing all this information. So this helps lenders determine how likely you are to repay your loan, and this in turn will affect how much you can borrow. No one is going to let you borrow a $50,000 loan if you've only ever held a $500 debt. They're just not going to, because there's no proof that you can handle that amount of debt. So your credit score affects a lot of things, and this is also why I've been telling people, they'll ask me, oh, I have 800 credit score, blah, 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 this, that. Will I get approved? I don't know. I don't know. Because you have to understand that just because you have a high credit score doesn't mean that you have, let's say, that people will loan you money. It doesn't mean that your credit is bad, but just because you have a high credit score does not mean now anything you ask for, you will receive. You can have an 800 credit score with a thin credit profile and you will be denied. So you have to understand that A lot of things you can get with the high credit score, not everything. And the things that you probably are looking for, you will need to prove that you can handle debt. So when you apply for a credit card or anything, a mortgage, if you apply for an auto loan, lenders need a fast and concise way to decide whether or not to loan you money. And in most cases, they're looking at your FICO score. Now, why are FICO scores important? Well, this is why a FICO score is important to a bank, because I think for you to fully understand and comprehend how to manipulate a system, you have to understand it from the other perspective, which means you have to start thinking like a bank, thinking like a lender. And if you think like that, then it'll help you understand what you need to do in order for them to lend you money. So the company, which is FICO, they can provide lenders with an augmented score that not only includes detailed account history, but also analytics about the way an individual habitually handles debt. Imagine if you had a couple $1 billion and you're like, man, I'm going to make money by lending out my money to other people. I don't have time to talk to 1 million people, right? I don't have time to evaluate 1 million people. What's the fastest way I can mitigate my risk? This company comes in and say, hey, we have this report. It basically tells you how well this person paid for the last however many years. And based off of this, we usually have a 90% success rate. So when we say that this person is good, they're good. And based off of that, now it takes a lot of the legwork, off of my plate. Now I don't have to talk to 1 million people. I'll use my system. My system tells me whether or not this person is loanable, like whether or not they'll pay me back. And based off of that, if it's right 90% of the time, even if 10% of you default, most of the time I'm going to get paid back, which is really all I need to be profitable. All right. So that's how you need to start looking at this when you're thinking about people loaning you money. So it's basic risk assessment. The fact is, a good FICO score can save not only that bank or that lender thousands or hundreds of thousands in their case, it'll also save you thousands of dollars in interest and fees, because, hey, if your credit score is bad, it's not that I won't lend to you, but if I lend to you, I'm going to make you pay a lot more than what I would normally make the other guy pay who's likely to pay. I might lend to you, but the amount of money it's going to cost you to pay me back is going to be like triple what that guy would have paid, which is why I've always said a lot of these things are predatory, and you make more money off of subprime lenders. You make more money off of people with bad credit than good credit. So, of course, when people have bad credit, it is an opportunity for you to make money. You have to look at this like a business decision. Now, you can save thousands of dollars in interest, and hopefully, if you're doing business, you can possibly use this to also grow your own wealth, right? By taking debt and leveraging it. But lenders are more likely to extend lower rates if they're presented with less risk. More risk, they still may approve you, but the amount that they're going to approve you for will end up being so catastrophically high that it doesn't even make sense to borrow the money. If you asked me to borrow $500, would it make sense if I asked you for $2,000? You would say, hey, it's just $500. I got to pay you $2,000 back. That's just too much. It doesn't make sense. I'm paying you 4 times what you let me borrow. And that's the whole point of when we look at interest rates, why just taking money doesn't make sense if the interest rate is astronomical. It doesn't make sense. And that's an exaggeration, the 4 times, but it could get pretty bad, especially when people don't actually look at compounding interest over a long period of time. They may not realize it, but for a lot of auto loans that are predatory, you may end up paying double for a car, when if you would have just had a slightly better credit score, maybe you could have only paid 7%. So that's the reason why this is important for both sides, for us as a consumer and also for the lender. It's important both sides. So what's the difference between FICO scores and non-FICO credit scores? Again, I had a video where I talked about your Vantage score. Vantage score is a scoring model that the credit bureaus came up with. The credit bureaus basically tried to say, hey, we can do our own scoring model and we can make money. but FICO score is the one that's most widely recognized. Notice how whenever you look at a free FICO score, it always shows the Vantage score, i.e. a Credit Karma. Even, they show it on Equifax and TransUnion, of course, because that's their scoring model, right? You want to promote your own product. However, whenever you look at a FICO score, you normally see a FICO 8 credit score, and that's the one that you have to pay for because it costs money. I also have that same video that shows you how you can see all of your FICO scores for free. I can tell you again in this video that you can get your FICO 8 score with Experian free once a month by setting up a free Experian account online. I'll probably link that video here or at the end. You can also get your Equifax score for free if you sign up for the My FICO app. So FICO has an app that you can get all 3 scores on for a price, but if you at least download the app and set up an account, they'll give you your Equifax score for free, and it actually updates anytime your score changes, but technically it's supposed to be once a month. The last way that you can get your TransUnion FICO score, you used to be able to get it with Discover. They had a free website account that you can sign up for, and they would give you your TransUnion score for free, your FICO 8. Now, if you have a Barclays credit card, if you have a Bank of America credit card, then you can get it for free. I think that there's like 1 more or 2 more. Oh, and Discover, I believe. If you have a Discover credit card, a Barclays credit card, a Bank of America credit card, then you can get your TransUnion FICO 8 score for free without having to pay. Other than that, if you don't mind paying, then you can actually just subscribe to Experian. They have all 3 scores that you can get updated once a month, and the price changes, so I won't even try to quote the price because it'll change depending on when you watch this video. Just check their website. FICO also has it, but it's the most expensive, I believe, because of all the other scores that they give you. So I don't know if I would recommend that one. I'm not endorsing one or the other, but there's a couple different websites that will give you your FICO 8 score for a price. Again, free once a month, those other ways, but you decide how you would like to get that score. Now, FICO scores are unique algorithms to calculate your credit risk. And based on the information contained on your credit reports, while many other companies design their credit scores to look like FICO scores, the mathematical formulas they use can vary greatly. That's the same thing I said about Vantage scores. Now, even though you can have a Credit Karma score, like right now, my Credit Karma score is almost the same as my FICO score. It's fairly close, but not the same. And then there's also other FICO scoring models where it's completely off. So that's the reason why if you just want to look at your credit report and look at the accounts and everything like that, the information is usually consistent. If you look at the score, it can vary. And, the main thing is you just want to know who pulls which one. That's the main thing. That's something that really matters. Now, unfortunately, the methods used by these other companies can lead to credit scores that are very different from FICO scores. And even just a few points of a difference can significantly change the terms and rates, potentially costing you hundreds or even thousands of dollars. Think about your mortgage. The difference between having a very good credit score and a fair credit score is only like 10 points. What you could get in an interest rate on a mortgage just by 10 points could cost you thousands of dollars. That's why you always want to be in the excellent category. So pretty much like once you get to 800, whatever you get at 800 won't be any different than what you'll get at 850. It doesn't really matter. Just like when you get to around like a 750, what you get at 750 is the same thing that you get at 799 as far as interest rates for the most part. So, I mean, once you're very good, you're going to get the good interest rate. And even to some of them, when you're very good, you still may get the excellent interest rates. It kind of just, it's kind of all the same after a certain level. And then the more you apply for things, the more you take a look at it, you'll see what I'm saying. Now, I'm hoping that you could see this. I tried to make it big enough and I didn't add anything. I don't want it to be flashy. I just want you to be able to see this. FICO score versions. These are going to be under Experian, Equifax, and TransUnion. The most widely used versions for FICO will be your FICO 9, your FICO 8. That's going to be for Experian as well as Equifax as well as TransUnion. Now, when it comes to auto lending, you're going to see your FICO Auto Score 9, your Auto Score 8, your Auto Score 2 with Experian. Equifax will use the same ones, your Auto Score 9, your Auto Score 8, but they'll also use your Auto Score 5. And then TransUnion will use Auto Score 9, Auto Score 8, but also your Auto Score 4. So as you can see, depending on which one, it can actually vary. The score you have can vary, which can change the interest rate that you get approved for, which is still, that's a very important thing. Now, versions used in credit card decisioning. Now, this is the one that a lot of people ask about. Bank card score 9, bank card score 8, score 3, and bank card score 2. That's for Experian. I'm going to tell you now, the most important score that I would say is your bank card score 8. I mean, 8 is pretty much the basis for all of these. 9 changes a little bit, and there's even a new FICO 10, but these are the ones that are widely used. Now, FICO 9, bank card score 9, and bank card score 8 is used with Equifax, but as we know, a lot of places don't pull from Equifax, but if they did, it's one of these. And then bank card score 5. And then the difference between TransUnion is that sometimes you'll see the bank card score 4. And then versions for your mortgage lending, they're different, right? You give score 2, score 5, and score 4. But for mortgages, normally they pull all 3 credit bureaus. They will add up all the scores divided by 3 and get your median score. So somewhere the average of all of them will be what you get for your score. And again, the newly released scores are FICO score 10, auto score 10, bank card score 10, and then there's a score 10T, which is trending information. And then you have the same thing with Equifax, and then the same thing with TransUnion. Now, with a new FICO score version like FICO score 10 or 10T, the company FICO will release this to the market, right? From there, each lender will determine when or if they upgrade to this latest version. Some lenders may make the upgrade very quickly, while others may take longer. And this is why some lenders are currently using different versions. And some of them still use, FICO 8. Some of them use 9. FICO 10 has been out since 2020. I have not seen anyone using FICO 10 quite yet, but most of the time you will see for at least credit cards 8 or 9. For auto loans, I've seen auto loan score 2. I think I've seen 8 and 9, but it just varies. You'd have to be getting, how many of us are getting a bunch of auto loans? So it's not always like that, but I've seen FICO score auto score 8 and auto score 2. That's mostly the 2 that I've seen, and most places pull from Experian. So that's going to be the one that you'll probably primarily have to focus on. Now, again, some lenders make the upgrade quick, some don't. And as an example, FICO score 5 at Equifax is the FICO score version previous to FICO score 8. So they used to use 5 and you'll see it pulled sometimes, but now they use 8. Again, how often is Equifax pulled though? Mainly it's Experian and TransUnion. And there's, again, other industry versions. We talked about the mortgage. We talked about the auto. And FICO scores are evolving. They keep up with behavior and they keep up with needs. Think of how people use like different versions of operating systems for a computer or like your smartphone. They all share the same basic functionality, but the latest version also has some unique updates that will meet the evolving needs of the business or the industry. So I want to give you an example. On your FICO score 9, the underlying foundation is pretty much the same as your FICO score 8, except for this. Any third-party collections, including medical bills that have been paid off, no longer negatively impact your FICO 9 score. So let's say you had a medical collection that you did pay, and you're like, oh, I was approved for a $25,000 credit card with Navy Federal. Well, Navy Federal is notorious for pulling your TransUnion FICO 9. So if you had that and you paid it, that's the reason why. It's because this new FICO model doesn't really take that into consideration when it's paid. So that's something to consider. Something else is rental history. There was a time where for your FICO 8 score, rental history really wasn't considered or as like a weighted factor. But rental history now, when it's reported, factors into your FICO 9 score. And this may be especially beneficial for people with limited credit history. So if you didn't have a lot of stuff on your credit history and you were able to report your rental, which I think now lenders like or credit builders like I believe Kickoff is reporting rental history. There's links below for all the credit builders if you guys want to check those out. But you can now benefit from a few more things when it comes to these new FICO models. And then we'll get into a little bit about what FICO 10 entails for maybe in the future when it's more readily used by lenders and other institutions. So again, the FICO score 10 is the most recent update, and it's the latest FICO scoring model. So FICO score 10 relies on the same design and key ingredients of prior models, as well as capturing shifts in consumers' credit data. And that's going to be the data that occurred over the past 5 years. Now, since it came out in 2020, we're talking about from 2015 to 2020, and they may do a new scoring model in the near future that may base behaviors off of what was going on from 2020 to maybe 2025 or whenever they release it. Now, they did notice that people were increasing their use of personal loans, especially for the purpose of debt consolidation. And as long as consumers practice good habits like consistently paying bills on time, lowering their debt as much as possible, and only applying for credit when needed, they can achieve and maintain a good FICO score 10. So if or when a FICO score 10 becomes readily available, I will know that hard inquiries may have a heavier weight. How credit seeking you are, debt to income ratio or utilization may be weighted a little bit more, only applying for things when you need it and paying them down as much as possible. So FICO score 10T builds on FICO score 10 by also assessing trending credit bureau data. So when determining your score, scores that don't use trending data typically use the most recently reported month of data to drive certain components of your score, such as recently reported balances and credit limits on an account. So a lot of the FICO score information is based off of an average of time, right? When they're looking at 10T, if this ever becomes available, FICO score 10T will be a trending amount, which means it'll heavily weight what you're doing currently, not what you've done in the past. So, but depending on how that goes, you having a long, extensive credit history where you were paying off most of your balances maybe 5 years ago, but maybe you're not doing it now, may negatively impact your score overall if people end up using, or if these lenders and institutions end up using your FICO score 10T. Now, the trended data allows the credit scoring model to determine what your trend is, and are your balances trending up? Are they trending down? Are they staying the same? Someone whose balances are trending up may be higher risk than someone who has a balance that's trending down, or someone who's staying the same. And again, FICO score 10 and FICO score 10T are currently available to lenders at this time. But me personally, I think I probably apply for more stuff than the average person. I have not seen this scoring model not one time. I've seen FICO score 8. I've seen FICO score 9. I've seen FICO score for auto 2. I've seen 8. I've seen 9. These are the ones that I'm seeing primarily being used right now in order to approve you for anything. And then we'll just touch on the difference between FICO scores and industry specific FICO scores really quick. So base FICO scores such as FICO score 8 are designed to predict the likelihood of not paying as agreed in the future or any credit obligation, whether it's a mortgage, a credit card, a student loan, etc. So that's the reason why when you log on to basically any FICO scoring model, the first one they always show you is your FICO score 8. And the FICO score 8, just think of that as like the base. Like that is like, okay, this is where I'm at. The other ones may weight something else a little bit more, a little bit less, but this is like your base right here. So you should really be focused on my FICO Score 8. Industry specific scores incorporate the predictive power of base FICO scores. So they take your FICO 8 score. They also provide further refined credit risk assessments, and they tailor it to that specific type of credit that you're applying for. So when you have like a bank card score, FICO 9, you may say, oh, I have a 780 credit score. Okay. But based off of your bank card score, FICO 9, you may not get a high limit because they may deem you as risky for whatever other information that they're using in order to get you that score. So you also have your FICO auto score or any of the other models, the one for mortgages. Many lenders may use these scores instead of your base FICO score. So if you ever get a letter in the mail and you're wondering why the score is different, that's the reason why. It's up to each lender to determine which score they will use and what other financial information they will consider in their review process. That's the reason why if you guys ask me, I have this score, this, will I get approved? I can never tell you. I don't know. I can only give you a guess based off of available information. But the bottom line is if you have a very high score, if you have a history of handling large amounts of debt over a long period of time, then yes, more than likely you'll always be you'll be approved. But just don't think because you have a brand new 800 credit score with a very thin profile and no history of handling large debt on your own that you're going to get approved for a lot of, and this is going into business credit, but a lot of things, because that's not the case. It's a lot of other factors, which is why sometimes you start off with a low credit score and they will give you something based off of how you handle that. So how you handle that will determine what you get approved for. And not only that, but they'll also look at what's your internal banking score, like how Navy Federal has their internal score. Every bank has something similar. There is a bank score that is determined by how much money you leave in the bank, how often you make your deposits, and then how many products that you have with them. So, there's a lot of other factors to consider, not just what your FICO score is. So just keep that in mind. Which FICO score version is important to me? And how I would basically do this is under these guidelines. Financing a new car, you'll likely want to know your FICO auto scores. That's an industry specific score used in the majority of the auto financing industry and when they relate to credit evaluation for getting approved for a car loan. If you're applying for a credit card, you'll likely want to know your FICO bank card score or FICO score 8. That's the score version used with many credit card issuers. Now, if you're purchasing a home or refinancing an existing mortgage, you'll likely want to know the base FICO score versions previous to FICO score 8. So before FICO score 8, you'll notice when it comes to mortgages, they're using FICO score 2, 5, the previous versions. You want to focus on those if you're looking at a mortgage. For other types of credit, such as personal loans, student loans, and retail credit, you'll likely want to know your FICO 8 score, which is the score most widely used by lenders. So just think about it like that. FICO 8 is going to be your credit cards. It's going to be your personal loans, your student loans, etc. You're going to be using your FICO auto score if you're looking at getting a car, and then your older FICO scores, 2, 5s, 4s, things like that, when you're looking at getting a mortgage. So you'll want to, go off of that guideline whenever you're looking at getting approved for something, and being aware of those scores will more than likely get you approved. But I would say 92% of approvals will come from FICO 8. And then you also want to consider that most lenders pull Experian. So that's why I always primarily focus on keeping my Experian score high, because it's like the most used credit bureau, and then TransUnion comes up next. I try to make sure I keep both of those like really, really good. And of course, I got to keep Equifax solid too, because if I want to get mortgages or things like that, anything related to real estate, I need to make sure all three are good. But if I had to put them in order, Experian's number one, the number one score that you want to make sure that it's taken care of. TransUnion comes in at number 2, and the one that's dead last, that's to me only really important, for a few different lenders. And when you need to get a mortgage, because you need all three scores to be strong, then that's where you can then focus on Equifax. But also know that there's a different range for each version, and the versions can range from 250 to 900. And I believe that with the FICO 9 score, I think it goes up to 900, compared to 300 to 850 for the base, which is your FICO score 8. So just keep in mind that that can also change, and you may see like higher scores when you get those letters in the mail for approval or denial. So, you know, very rarely do I ever see that talked about, but you can have a 900 score depending on which FICO model that you're looking at. And then for the one that is most widely known, your 850 would be the highest. And I said this before too, no one can have a credit score lower than 300. I talked about that in a different video. 300 is your base. And then for the other model, no one can have a score lower than 250. Again, that's like the bottom, but rarely will you probably ever be looking at that one. Again, FICO 8 is the one that you're probably going to be looking at for ranges and things of that nature. This is just the breakdown of how the scores are. Again, this is what the FICO 8 uses. These are all the components. I've talked about this. I won't do it again. 35% of payment history, just to go over it briefly. That's a majority of your score. On-time payments. If you have one missed payment, it will destroy your score. Always know that you can't miss one. You have to be perfect. If you're not perfect with payments, it will destroy your score. 30% is amounts owed, which is utilization. If you don't have a credit card, you cannot get utilization. So that is imperative. You need to make sure that you have a credit card, because if you don't have one, you basically are giving up or forfeiting having a really good score. 10% is new credit, which as you can see is not very big. And I think that would let you know you should have a primary focus on letting your credit score age. I did a video on trade lines for authorized users a while back, even though, you know, that was a good little trick in order to get approved for auto loans. The main thing is you need to let your credit score age. You need to season it. It has to show that you've had this for a while. That will end up helping you when you get close to like the 780 range. Like one of the only things that'll really move that score is going to be credit age. So you definitely want to make sure that you do that. 10% is also credit mix, which is the lowest as well. Thank you guys so much for watching this video. I really do appreciate it. I hope this answered a majority of the questions that I have been getting about FICO scores. I hope that this answers FICO scores versus credit scores. I hope you have a better understanding if you get letters in the mail. When you get a letter in the mail and you're approved for something, you notice how that letter will show you what was weakening your score. That's normal. It's almost like if you had all A's on your report card, but one of them was an A minus. It might say, ooh, A minus, work on this. It doesn't necessarily mean that that's a problem. It just means that when they were looking at it, this was the one thing they found as a potential weakness. But what I've noticed is no matter what you do, unless you have a perfect score, they're always going to point out something. If I ever have an 850, I'll apply for something and then see if, I'm assuming if I apply for something, maybe it might drop it. But if I have an 850, I don't know if I would get anything, because then at that point, your score couldn't be any better than what it is. So unless you have a perfect score, you're always going to get a letter, whether you're approved or denied, that will say something was wrong. Now, if it's something you can, work on it. If it's, if it's an approval, but it says it, I wouldn't really worry too much about it. I would just, it's always going to say something. Other than that, you guys have a wonderful day. Thank you so much for watching this video.